All right, welcome back, everybody. Road to Retirement podcast. Today is October 12th. Tony Marlette Jr. here at Brookside with Tony Shore over at Gradient. Good morning, Tony.
Well, good morning to you, Tony. Great to be here with you.
All
I'm
right.
excited about our show today.
Me too. Looking forward to it. I'm sorry about your twins. I was watching the game last night. I don't know
Oh,
if you were, but
I watched. Oh, believe me, I was
yeah,
watching the game for sure. Yeah.
I thought they had a couple of rough strike calls. I don't know,
I,
here and there. I don't know how that influences big picture ever, but at the same time, you don't know.
yeah, the umps. I thought even on both sides, even for the other team, I thought the calls were horrible on strikes and balls last night. I mean, that was interesting, but I'm not going to use that as an excuse. I mean,
Sure.
we fell down. We just didn't get the hits we needed. So their pitching was pretty good. I have to admit. So
Yeah. Yeah,
yeah,
they
but we got further in the postseason than we have in I don't know. I mean, since the '90s. So
yeah, it's been a while, and they had a really good season. I know firsthand, obviously,
Indians
as
fan,
an Indians Guardians fan, I know firsthand they had a really good season, and
Guardians. Yeah,
they they put us to bed pretty quick in August. So we all saw that firsthand. And I
yeah.
think everybody in America honestly was rooting for them. Nobody wants the Astros to win.
No, no, except for a handful of Astros fans in Houston. The rest of the country,
Correct.
people who want the Astros to win, and it's literally the city limits of Houston,
Yeah, you're probably right.
right? And then the rest of the country is the people who don't want the
Right.
Astros to win again.
Yep.
Yeah, the Twins. I love the Twins. I love my Twins. I saw 2 or 3 games I got to go to this year, and it was a lot of fun. It
Yeah.
really is. They're a great team. I really enjoy them. So, Tony, what are we talking about on the show today?
I wanted to go over, a lot of people are into fall. I like fall. It's my favorite season. Things start to cool down a little bit, get a little crisp. We're into the fourth quarter. I thought we could do a financial checklist before the end of the year. We're not talking about end of the year yet because it's still only October. But since we're in the fourth quarter, some things to think about to get going
Yeah.
before the end of the year while you still have time.
Yeah. That sounds good. A year-end checklist, what you need to get done before the end of the year. I like it. Or financial steps for fall, as you
Yeah.
call it. That's
Yep.
that has that's great alliteration there. Financial
There you
steps
go.
for fall. I
That's
like it.
right. And I always forget there's we do this on video, but primarily people listen to it. So
Right.
you always call out, what's that phone number? What's that say? Just so our listeners, not necessarily our viewers, but so our listeners can understand what we're doing. So I appreciate that.
Yep.
So our first thing I think, and probably most important, is to make sure you've taken your any required minimum distribution that you're required to take. Now, required minimums are only required from retirement accounts. Roth IRAs are the exception, but any other retirement account you have, IRA, 401k, even as of for 2023, a Roth 401k, you have to take required minimum distributions. Now, a lot of times, if you're drawing down on those assets throughout the year, that's going to meet the required minimum.
Right.
But if you don't take that by the end of the year, as you know, obviously there are stiff penalties involved.
Well, yeah, and you don't want to have to pay the penalties. So you need to
Right.
stay on top of your RMD situation. So if you're in your 70s, if you're 70 or older, you need to look at, okay, when do I need to start taking those RMDs? How much? What accounts? And that's where you guys come in, right? I mean,
Yeah.
if our listeners and viewers out there have questions about this, they can just pick up the phone and give you a call, right?
Yeah. That's part of the value of, we talk pretty regularly about the value of working with an advisor. It's not
Right.
just picking stocks, but we track all this for you. I've had clients call me, and you brought up a good point about, they went about 30, 40 years, the IRS did, without changing RMD age. It was 70 and a half forever.
Yep.
It's changed 3 times in the last 5 years now. So
Yeah.
there's a lot of uncertainty. I get stuck sometimes and I'm like, okay, which one is it? If you're born in what year? So for now, it's 73 is your required minimum distribution start age. If you've already had RMDs being taken out, you have to continue them.
Yeah.
But and I remember this because it's relevant for my dad, who's going to be 73 next year. So he's in that spot where he gets to start at 73 and start taking them there. But if you're not sure, like you said, it makes sense to call your advisor.
Yeah, exactly. And it's just a part of your overall financial plan. But you need to make sure this time of year you review where you're at.
For sure. And again, if you're not sure, it's better to call and find out. Your advisor should be tracking these things and should have these set up. A lot of companies, Gradient included, they don't want people to miss their RMDs either. So they're going to make sure they're going to send you a letter, or they're going to just automatically send the payment and say, here's your payment, because nobody wants to pay that 50% penalty.
No. Actually, it was reduced to, I think the last Secure Act reduced the penalty to 25% starting.
That's correct.
Is
Yep.
that this year or next year? So
that's 24. So,
yeah.
but point taken, you're correct.
Yeah. So starting next year, it drops to 25. Still the largest penalty in the IRS tax code at 25%. I mean, who wants to give up any 10% is a big penalty, let alone 25 or 50, right?
Absolutely.
Yeah.
Absolutely. I agree. Another big one, and this one's relevant pretty much right now this week, is Medicare open enrollment. And although this isn't financial necessarily, it's still a big part of people's retirement. And open enrollment runs every year, October 15th through December 7th. A lot of the benefit we've seen on these is people who have not enrolled in either a Medicare Advantage or a drug plan, or just have Part B coverage and they're past that 9-month window, can opt in to supplemental coverage like an Advantage plan or a Part D plan. Now, you're still going to pay a penalty, but this allows you the opportunity to get enrolled, and at least if you pay a little bit more, to have coverage beyond what just Part A and Part B cover.
Yeah, it's also known as the annual election period. I've heard it said. And so if you're already in Medicare, you have it goes from, I think, October 15th through December 7th.
That's correct.
Are the dates. And so that's Medicare open enrollment, or the AEP annual election period. And you're right. I mean, that's a good point, Tony. Now is the time to make sure you're getting the best deal. The idea here, right, Tony, is to maximize your coverage while minimizing your cost, right?
Yeah, I couldn't have said it any better. That's correct. So a lot of times, if somebody they say they opt into Part B when they're still working, they work another 5 years and then they go to join a plan. Well, your initial enrollment period into a Medigap or an Advantage plan or a Part D is contingent on your Part B enrollment. So a lot of times what people don't look at is, well, I was still working, I'm off credible coverage. That's fine. But you enrolled in Part B 5 years ago. Now is the time to get enrolled if that's the case. It's almost like everything is forgiven and absolved, even though, yes, you'll still pay a penalty. You can't just enroll at any time. So it's a very important time. And you mentioned too, if you're on Medicare, you can make changes too to go back to just regular Part A, Part B if you want, or go the other direction, Part A, Part B, to an Advantage plan or a drug plan.
Yeah, supplemental plans, drug plans. Used to be called Medigap, but now it's supplemental. I mean, there are things Medicare doesn't cover, and I would use this time to make sure you have coverage for things like hearing, vision, dental, the things that standard Medicare doesn't cover. You need to make sure that you have the right coverage for your personal situation. Of course, as you always say, Tony, everybody's situation is different, right?
That's correct.
Yep.
That's right. That's good to remember. And like you said, they don't cover everything. It kind of has a dropping off point, so you're going to want that supplemental coverage in there too. One other big thing we commonly, if there's one common retirement date throughout the year that people have, it's probably December 31st. So for whatever reason, whether it has to do with a profit sharing or a matching contribution or health benefits or Medicare, if there's one common date, I think that I've seen people announce retirement or when their last day is going to be, it's often December 31st. So
Yep, January 1, start fresh into retirement. So that's a big date for a lot of our listeners out there because whether it's this year or next year, that's the date that they want to retire. That's their final day, right,
right,
of work.
absolutely, absolutely. So, and again, like if it's a kind of a mental accounting thing where you're like, okay, well, I want to work this full year, and then the very next year I'll start the year off being fully retired. I mean, who wouldn't want to wake up on January 1st or January 2nd when everybody else is going back to work after Christmas and New Year's and holidays and Thanksgiving and not have to go back to work? That's pretty awesome.
Yeah. Yeah, I would say that's great. That's really awesome.
So for this, one thing that I always, a lot of things I recommend, but amongst them, make sure you have your Social Security in check. If you're going to be retiring December 31st and you have not filed for Social Security yet, make sure you know what your options are. I think healthcare, we just mentioned Medicare, but I think healthcare is just as big. And by the way, I meant to mention about Medicare. We sent out an email about open enrollment to our clients. So if you're a client of ours at Brookside, you'll be getting an open enrollment video, just kind of walking you through some things and how we can help in your email
That's
today.
helpful.
Yeah. But healthcare obviously is really important too, whether you're going to be doing COBRA for a year or two, or the Affordable Care Act exchange, or whether you're just going to jump right onto Medicare. It's always important to have that taken care of ahead of time.
Well, definitely. And so you have to look at things like Social Security, Medicare, if you're going to retire. And so the end of the year is the end of the line as far as work is concerned for a lot of people. That's one I don't always see on a lot of year end checklists because they're not taking that into consideration because it's not for everybody, but those who are retiring, that's huge. Yeah.
For sure. Yeah, for sure. And then one other thing on the 1231 retirements, meet with your advisor. Make sure your asset allocation is proper going into retirement. We talk about sequence of returns, and if you have to start drawing down on your portfolio, you probably do not want to draw down from assets that are losing value. Meet with your advisor, meet with your financial team or your professional, and have a plan in place, and it should be somewhat flexible too. So I know we use, with help from our friends over at Gradient, we use a retirement compass that we can show people sequence of returns and why it matters. And then, hey, let's draw from bucket A, wait to draw from bucket B, and then we're going to incorporate Social Security into all this. So it just makes sense to have a plan and know specifically where those withdrawals are going to come from.
Yeah. Yeah, that makes perfect sense. And you know what? I love the fall. I love this time of year. And this is a perfect show for the fall because these are the things we need to be looking at. And again, I encourage our listeners to contact you guys, make sure they have a plan in place and review where they're at. This is the year. And I also, you know what? I heard this just yesterday. October is financial planning month. It's the official financial planning month. Did you know that, Tony?
I did not know that. So thank
Yeah,
you
I just
for
heard that. Yeah,
bringing that up. That's
yeah.
very relevant. So you're a fall guy. Are you a pumpkin spice guy is the question.
No, I am not. Absolutely not. I mean, that pumpkin spice thing is out of hand. I mean, I went to the gas station the other day. Did I tell you this? I went to the gas station the other day. They had regular unleaded, supreme unleaded, and pumpkin spice unleaded. It's like, what? Everything's pumpkin spice nowadays. So,
Yeah, honestly, I'm with you. I used to be kind of on some of the pumpkin stuff. The pumpkin beer was one thing that I liked, but I don't know what it is. I don't know if I got sick of it or if everything has been just totally overdone at this point. But
I used
uh,
to like the pumpkin spice coffee drinks that they had, like when they first came out. You know, I'd get excited each year for the first couple of years. I'm sick of it
yeah,
because now it's everywhere and everything, and it's too much.
yeah, we should have just called this the Pumpkin Spice Podcast today.
No. Well, we probably would have gotten more viewers than listeners. Ooh,
I yeah,
pumpkin
there we
spice.
go.
How are they gonna do that in a podcast?
Yeah,
Right?
yeah, absolutely.
Yeah, but you always bring the spice, Tony, you know that.
Oh, ooh,
Yeah.
I like that.
Yeah.
I like it.
So what else for fall? Is there anything else we need to know
So
about?
we've talked a lot about stuff that it probably affects retirees or soon to be retirees more, but there are some things for workers that we can consider as well. And as you know, we have a giveaway that we do on our show for a code word. Our code word for today's giveaway is going to be workers. So you go to onestopadvisors.com/giveaway. Again, it's onestopadvisors.com/giveaway. For October, the giveaway is a honey baked ham.
Oh, wow.
Yeah. So enter that code word. Again, it's workers, and you'll be entered into a drawing to win this month's prize, which is a honey baked ham.
Am I eligible? Because I'm going there right now.
All right. Yeah, you're eligible. Go ahead. I'll stuff the box for you.
No, no, we're not eligible.
No,
Employees
no,
are
employees are
not.
not eligible. Nope, of
No,
course not.
no. We can't have Chris Anselmo entering to win his own ham.
I was just going to say, have Chris just buy you one. He'll send you one.
Yeah, yeah, I should tell him. Hey, how about a little something for the co-host, huh?
That's right. That's
Yeah,
right.
I like it.
So other things to consider, and these are more for current workers, your IRA contributions and 401k contributions year to date, where are they? So this can affect your taxes for this year too. So your IRA contributions, if you're eligible to have them deducted, or even Roth IRA contributions, if you're able to make them up to a certain point, compare that with your income just to make sure you're able to do that sort of thing. And if your IRA contributions, if you think you're having a good year, um, you know, financially, and you look at your income and your tax bracket, and you say, you know what, I'm looking at having a larger tax bill than I thought for next year. There are things you can do before the end of the year, like increasing 401k contributions, which are always tax deferred if they're pre-tax, not Roth. And then same thing for IRA contributions. If you're not doing 401k contributions, make those tax deferred contributions, and they lower your taxable income for tax purposes.
Interesting. That's really important. Another thing, and maybe this is on your list. I don't want to jump the gun, but that makes me think of um, last minute contribution. Extend your contributions, or like if you're 50 or older, right? You can make
Absolutely.
catch up contributions. That's the word I'm
Absolutely.
looking for.
Absolutely. Yeah, and I mean, you're able to contribute more to a 401k. They change those limits every year. It's if you're 50 or over and you're contributing, you're allowed to put in an extra 6,500 or 7,000 per year, as opposed to if you're under 50. So take advantage of that. And again, if no other reason, those contributions are knocked off of your income for the year for tax purposes. So if you're, seeing that you're going to be making a little bit more money, it might be worthwhile. Or if you're making a little bit less, if you're not having the year that you thought you were, adjust your tax withholding too, because maybe if you're making less, you take home a little bit more. If you're making more, maybe you want to have more taxes withheld so you don't get sticker shock when you come to Brookside Tax next year and we say you owe X amount of dollars
Right. Right.
to the government, to the IRS.
Well, one great way to make sure that does not happen is to work with before you go to Brookside Tax for your year-end taxes or beginning of next year before tax season ends, and get that big shock. You'll want to go to Anselmo and Company, come in for the financial advisory side to get a plan in place, so you don't have that big ticking tax time bomb that surprises you, right? And you
Absolutely. I
guys,
love the phrase ticking tax time bomb, by the way.
yeah. Well, that's an Ed Slott. I stole that from Ed Slott, who's like the nation's premier expert on taxes, Roth IRAs,
Yep.
taxes, taxable
Yep.
accounts. If there's one man that knows more than everybody of the 77,000 page IRS tax code, it's him.
That's right.
Um, and you and I have met, we've seen him speak, I think, and I know Chris has met him and talked with him a number of times. And That's why you guys are so great at this. But I think that's really important. Obviously, taxes are a huge part of year-end planning, right? Before the end of the year, you want to make sure you know what your tax situation is going to be, to make sure, hey, do I need to make some charitable contributions, or do I need to max out my retirement account contributions, or play catch up with those catch up provisions that I'm allowed if I'm over 50?
Right. Yeah. And you brought up a good point. End of the year. That's why we do this now, because you still have, 2.5 months. But
Right.
a lot of things, most things you're not able to carry into 2024 and make retroactive contributions. IRAs, you can. That's about it. So
Yeah.
charitable, to your point, charitable, any medical deductions, any non-Schedule A type stuff that you're going to be doing, or stuff that does not either goes over the standard deduction or is not included in the standard deduction. You want to make sure you're doing before January 1st.
Ah, okay. Yeah, that's exactly right. Well, this has been a great show, Tony. Is there anything else you want to talk about before we have to go?
No, other than give us a call, 440-886-3550. You can visit us on our website at brooksidetax.com. Socials, Facebook, Brookside Financial, and YouTube at Brookside Financial as well.
All right. Well, great show today, Tony. Loved it. Year-end planning is so important, and what a great reason. It just illustrates why it's so important for our listeners and viewers out there to work with a trusted financial services professional like yourself, like Chris and the team there at Brookside. Again, brooksidetax.com. I'm going to read that number for our listeners one more time: 440-886-3550. And again, the secret word for this episode was workers.
Yep.
All
Visit us
right.
online and enter that word, and you'll be eligible for that prize.
All
Anything
right.
else today, Tony?
No, I think that's great. I think you covered it. And I want to let our listeners know, thanks for tuning in. That does it for today's episode of The Road to Retirement with our host, Tony Marlette Jr.
Thanks, everyone.